Welcome back, Strategic Traders session number 19. We are almost at the end. We have now gone through how do we find a good opportunity? What is a good opportunity? How do we manage the opportunity? How do we enter and exit the opportunity? So now let's talk a little bit about what is it that we're trading, right? What is it that we're going to be utilizing in order to access this market? So when we are looking at this in session 19, it's all about asset classes from a 30,000 foot view, right? We're looking at it from a 30,000 foot perspective. We're not going to dive into the intricacies of each individual asset class, but I want to at least talk about the four main asset classes from a very high level so that everybody understands what they are. Now, for the purposes of today's conversation, we're not going to dive into cryptocurrencies. That's a completely separate conversation, but everything we talk about is still going to be relative to that same market. So, our four main asset classes: stocks, futures, forex, and options. So, let's start with stock. Um, Stock represents ownership in a company, right? When you own stock, you own a fractional percentage of a company. That's really what you do. You're buying in. And why would somebody buy stock? They buy stock because they believe in the long-term health of the company. It's the most popular trading vehicle in the United States. It is an engine that really drives a lot of the economic policies that happen throughout the U.S. And what a lot of people don't realize is that the stocks have been traded in the United States since 1792. The first stock market opened in the U.S. in 1792, and stocks have been around for hundreds of years. Even before that, the London Exchange is significantly older. The Bombay Stock Exchange is older. So there are older stock exchanges all over the world that people have all been a part of in their, in the history of stock exchanges. Now, when we look at stocks that have been around forever, these stocks, they can be traded in a multiple of different ways. They can be traded as individual securities, meaning you're trading the individual issue. Stocks can be traded as ETFs, exchange traded funds, which are baskets of stocks. Or you can trade them in a mutual fund, right, which is another basket, or maybe even trade an index. So stocks are traded on their own or they're traded in baskets. And when we look at stocks, they trade in dollars and cents. And that may seem somewhat remedial, but they trade in US dollars and cents. So each dollar represents a point, right? Each point is a dollar, and each cent is what's called a tick. Now that's going to become much more valuable when we talk about futures, but they move in increments of 1 penny at a time for most individual retail traders or investors. Now, when are stocks traded? Stocks have a market hours of 9:30 a.m. Eastern to 4 p.m. Eastern, essentially Monday through Friday. Now, there are pre-market hours that start before that, and there are post-market hours that happen after that. So there's pre and post-market trading that's available. But for the most part, it's 9:30 to 4. That's the main stock market opening time, Eastern time. Now, there's a couple of advantages with the stocks. First of all, the biggest advantage in my mind is the significant number of choices that you have. You have many, many choices available for investment. You have 15,000 or so publicly traded companies that you can then filter those down based upon price or volume, and really it gives you a vast amount of things to trade. The information on these companies is readily available. You have access to this information right at your fingertips because these are publicly traded companies. They can be traded either long or short, so I can make money either up or down in the stock market. Now, not all accounts allow me to make money in a downside due to the restrictions on some retirement style accounts, but I do have the ability to trade up or down. And then the other one that's I think really underutilized is the fact that they have a long-term investment opportunity, and traders don't always think that way, right? Sometimes a trader wants to get in and wants to get out, but sometimes it makes more sense to buy a stock at 12 and let it ride all the way up to 100 than it does to buy it at 12 and sell it at 15. And then you look at it a year later and it's all the way up at 100 and you think, "Oh, what did I do wrong?" So it has advantages in that you can keep it long term. There's no time decay associated with owning the stocks. So what are the disadvantages? Well, the first disadvantage is that it's not a 24-hour market. Things happen 24 hours a day, right? We're in a global economy that things happen 24 hours a day. And by not being a 24-hour market, it doesn't give somebody the ability to react instantaneously when something happens. And so what that causes is what are called gaps. And a gap is the difference between the closing period one day and the opening period the next. And those gaps occur when the markets are not open. So that's a disadvantage because those gaps can blow through a stop loss. Now, I think that the biggest disadvantage in stocks comes in the form of limited leverage. Stocks provide the limited amount of leverage. If you're trading stocks, you typically get a 2-to-1 margin leverage if you're in a margin account. Meaning if I buy 1,000 shares of a $50 stock, that's going to tie up $50,000 in my trading account. Well, if I have margin, it's only going to tie up $25,000 in my trading account. So I can get 2-to-1 leverage if I utilize a margined position. If I'm doing intraday trading, meaning I'm in and out the same day, then I can get 4-to-1 leverage. But for the most part, my leverage is limited to that 2-to-1 amount, especially if I'm holding it overnight. And so that becomes the biggest detractor, I think, away from the stock market. When you start to see stocks that are trading at over $1,000 a share, the idea of somebody buying 100 shares of a $1,000 stock just may be difficult, right? If you're starting to trade with a $10,000 account, stocks can be a little bit intimidating just based on the pure cost of those stocks. And that drives a lot of people to what are called penny stocks, lower cost investments, but they also have lower probability, right? Things that are cheap are typically cheap for a reason. Now, the third disadvantage that you have in stocks, I guess this would be the fourth on our list, is that you've got three levels of risk. Three levels of risk. So there's market risk, sector risk, and company risk. Let's talk about each one. Company risk is the risk that the company itself does something that causes the stock price to fall. Like, for example, a retailer comes out and says that they've had financial irregularities on their books for the last X number of quarters and that they are going to declare bankruptcy even though people thought that they were financially healthy. Well, that's a company risk, right? You take a company risk with any company, that the company makes bad decisions. But one level above that is what are called sector risks. And stocks are broken up into sectors: technology sectors, financial sectors, banking sectors, whatever the sector would happen to be. And so if a whole sector goes down, then all the stocks in that sector are typically going to go down as well. So, for example, let's say that there is some sort of a shortage on raw materials, right? Copper is a raw material shortage, and it's impacting the entire technology sector. Well, not only do you still have all the company risk, but now you also have all of the sector risk of that company. Well, one level above that is what's called market risk. And market risk means that I take the risk of the whole equity market going down because most of the stocks are going to go with the direction of the whole market. So in general, stocks are where a lot of people get started, but it's not where everybody finishes, right? It's not where everybody finishes. But stocks are a great place to think. So what about another asset? The other one would be futures. So looking at futures are an asset which is essentially a contract that allows you to control a certain amount of a given product for a certain period of time. Now, futures are a financial instrument that gives you control without ownership. So when you have control but not ownership, you typically get very good leverage. So you get futures for equities, commodities, energies, bonds, currencies, all those different things. And futures are traded 24 hours a day for the most part. So you can get in and out at any time of the day. It's available through multiple brokers, and it does give you the most availability to diversify because I can trade corn futures or metals futures or oil futures or S&P futures. And so when I look at the futures markets, essentially their hours are 24 hours a day. Now, they do close intraday. Individual contracts will close at different times for different periods of the day. But essentially, they start trading at 6 p.m. Eastern time on Sunday evening, and they trade all the way until 4:15 p.m. Eastern time on Friday. So this means that I have that 24-hour market, right? That's a huge advantage because it allows me to quickly take advantage of movements, and my stops, my protective positions, are always at play, right? So if the Asian markets sell off in what is the overnight in the U.S., then that might cause a gap in the U.S. equity market. Well, if you're trading the futures, then you can get out in the overnight session because of the 24 hours. It also gives you the ability to get in 24 hours a day, right? So maybe you're a very, very busy person and you work during the U.S. market hours, but you are a morning bird, a morning person. You get up bright and early, and maybe you want to look at the markets at 5 a.m. There's opportunities. You are a night owl and you want to look at the markets at 2 a.m. Eastern time. Well, that's still going to give you a good opportunity because there's opportunities 24 hours a day. Now, what futures definitely do is because you're controlling an item, instead of owning it, you get really, really high leverage. Now, I'm not going to dive into the details of the leverage here, but it's safe to say that I can control 50 or 100 or even $200,000 worth of product for sometimes like less than $5,000. Now, it's going to be a little bit broker specific, a little bit asset class specific, depending on what you're trading and what the margin is at the time. But it gives you sometimes 100 or 200 to 1 leverage when using the futures market. But every time you deal with leverage, you certainly take a little bit more risk. So we'll talk about that in a moment. It has a diverse, non-correlated market. And when I say diverse, non-correlated, what I mean is that the S&P doesn't have all that much to do with corn. Corn doesn't have all that much to do with copper. And copper doesn't have all that much to do with, I don't know, the euro. The point being is that I have multiple assets that are non-correlated, which means that I'm always going to find some sort of an opportunity that's not dependent on one another, right? Where in stocks, you had equity risk, sector risk, and market risk. In futures, I just have the risk of the individual security that I'm trading. Now, there are some correlations, right? Sometimes you'll talk about the crude oils and the Canadian dollars or gold and the USD, but there are many, many markets that are non-correlated. In the U.S., another advantage is that there's a 60-40 long-term capital gains tax treatment. So once again, this is kind of U.S. specific, but the earnings on futures, 60% of the earnings are taxed at the long-term capital gains rate. 40% are taxed at the short-term capital gains rate, which is typically the same of ordinary income. Now, I am certainly not a tax professional, and you should always talk to a tax professional about your particular tax situation, but futures may provide you a beneficial tax scenario, allowing you to still take advantage of short-term trading opportunities, but benefiting from some long-term capital gains tax treatment. And the last advantage that I'll talk about here is global exposure, right? I've got exposure to many, many, many markets all over the world, right? And all those markets will give you an opportunity so long as you know what to look for. Now, let's talk disadvantages. One is limited liquidity. So futures are not quite as liquid as stock. You might not get in and out at the same pace. And different futures have different amounts of liquidity, just like some stocks have different liquidity. And liquidity is how freely can I get in and get out at the price I want. And typically in futures markets, if you're trading the major futures markets that we talk about in our live trade rooms and in our futures class, we talk about things like the S&P, the NASDAQ, crude oil, gold, the euro. Those are all very liquid futures markets. You're probably going to be able to get in and out pretty easily. But if you start to look at some of the more unique futures, right? Bitcoin futures, for example, are currently not all that liquid. Maybe you're looking at futures of the Mexican peso may not be quite as liquid as futures of the euro and things like that. That mean that I may get a more slippage in my entry. And also there's less choices, right? I just don't have the same 15,000 contracts. There's probably about 25 good futures contracts worth taking a look at as a trader. So futures, I think, are a phenomenal asset class that give me access to the whole world's markets without having to be, paralyzed with fear because I've got that 24-hour stop loss. Now, Forex does much of the same thing, right? Forex, multiple currencies around the world, traded 24 hours a day, high degree of customizable leverage. So with Forex, we're talking about foreign exchange currency trading. Well, essentially what we're doing is we're trading dollars for euros, pounds for dollars. And when we talk about trading in Forex, you go to the airport and there's oftentimes going to be the desk that says currency exchange, right? We buy at, we sell at. If you're going to London, you might take your U.S. dollars. If you're in the U.S. and you're going to London, you might take your U.S. dollars and you want to go and exchange those for Great British pounds. Well, what's happening is what you're doing is you're buying Great British pounds with your U.S. dollars. And they're selling Great British pounds to you, and they're accepting U.S. dollars as currency. Well, they're not going to buy it for one and sell it for one, right? They might buy it for They might buy it off of you for zero point 0.9 and sell it to you at 1.1. And the difference between that is what's called the spread, right? And that's how a lot of these banks and currency brokers make their money. Now, this is the world's largest market in terms of pure dollars and cents that are moving through it. And it's a 24-hour market, high leverage, diverse, non-correlated markets, lots and lots of the same advantages. Also, lots of the same disadvantages as futures. The biggest difference in futures and Forex really comes down to the spread. I've got a much bigger spread typically in Forex than I do in futures. Now, the benefit of Forex is that I don't typically pay a commission, and futures have a higher commission. So when we trade Forex, you're trading one currency against another, and you are looking for that big leverage. And that big leverage is sometimes I only have to put up $2,000 to control $100,000 worth of currency, right? So I get 50 to 1 leverage. Or I put up $200 to control $10,000 worth of currency. Or I put up $20 to control 1,000. And so I'm going to get that 50 to 1 leverage, and it's very customizable to my risk tolerances. That's one of the big advantages of the Forex markets. The last market that we'll talk about are the options markets. And the options markets are the ones that are probably the most complex of all assets. Now, why do we leave options for last? Well, because I can have options on stocks. I can have options on futures. I can have options on Forex. So options are derivative products of other asset classes. So an option controls another asset class at a fraction the cost of ownership. Options are the most diverse asset class because there are many, many strategies that I can take. And so when we look at options, the options markets themselves are open Monday through Friday, 9:30 to 4. So, when I look at options, I've got the most choices for investments, right? Well, that's not true. I guess stock would still have more choices, but options give me more directional choices that I can do. Because in options, not only can I profit long or short, up or down, but I can also profit if the stock goes nowhere. And that is a unique, customizable strategy with options. See, we talk about options, we talk about 3D options, 3 directions, up, down, or sideways. And options is the only asset class that you can really put strategy around. How can I make money if the market goes nowhere? Right? It's a phenomenal way to understand how to make money if the market goes nowhere. How do I make really good money if the market goes my direction and I'm utilizing that leverage on my behalf? And how do I protect some positions that I have? Options, like I said, are the most malleable of all asset classes that we look at. Now, here's the disadvantage. There's a lot of intricacies in options to learn, right? The reason that we have multiple options programs set up for people to educate themselves is because there's a lot to learn with options. You also have to worry about what's called time decay, because an option isn't good forever. An option is only good for a given period or a given window of time. And the last thing you've got to worry about is volatility uncertainty. Volatility being how much does the market think it's going to move in a given window? And if that volatility spikes way up, your options value can change significantly. So whether you're trading futures, options, Forex, or stock, here's what I really want to get through to everybody. A chart is a chart. Is a chart is a chart, right? Every decision is still going to be based on fair price value areas, identifying zones of demand and supply that are going to give me the best opportunity for entry. So whether I'm trading Disney or silver or the euro US dollar, or I'm trading an option on silver or the options on Disney, I still need to look for those areas of supply or demand. I still need to find turning points. I still need to find breakouts. I still need to find good opportunities. Every good options trade first starts as a good trade. Well, every trade, whether it's futures, Forex, or stock, is going to come down to understanding fair price value. So, like everything else, if you've got any questions, make sure that you send us an email, support@tradersarmy.com. Shoot us a text, and I will see you in our next session.